Welcome back to Daily Digests for Wednesday, August 5th, 2026. The S&P 500 options market is flashing an extraordinary signal today. Derivative Skew plunged to a near record low of minus 0.12. Investors are aggressively buying upside call options while abandoning downside put protection, triggering a powerful Delta-hedging Gamma squeeze across the main U.S. stock index. Under the hood of this move, market makers who sell these out-of-the-money call options must continuously purchase spot shares and S&P futures to maintain a neutral delta position. As stock prices rise, their required hedging volume accelerates, turning speculative retail and institutional call buying into a mechanical buying engine for the broader market. That Gamma engine pushed the S&P 500 to an intraday high of 77.93 today, coming right up against the 7,800 call wall. This level represents a massive concentration of call option open interest, where market maker hedging shifts from buying spot to taking profits and selling into strength, capping immediate upside momentum. On the downside, technical support remains well-defined by the 7,700 put wall expiring this Friday, backed by secondary support at 7,650. As price approaches 7,700, market makers are forced to buy futures to hedge their negative delta, creating a strong mechanical floor that prevents a sudden collapse in the absence of fresh macro shocks. Away from derivative mechanics, enterprise AI efficiency delivered real financial proof today. E-commerce giant Shopify reported second quarter revenue of $3.58 billion, up 34% year-over-year. Management highlighted that AI-guided tools delivered order conversion rates twice as high as traditional channels, proving that AI investments are generating tangible bottom-line value. Shopify's gross merchandise volume expanded 32% to $115.5 billion, triggering a sharp relief rally across high-valuation growth stocks. The strong print helped reassure investors that end-user demand for software and digital commerce infrastructure remains intact despite broader macroeconomic uncertainties. Turning to economic data, the U.S. labor market is showing clear signs of cooling. The July ADP private payrolls report showed an addition of just 44,000 jobs, missing consensus expectations of 65,000 and marking the lowest monthly gain of the year. This deceleration provides fresh evidence that hiring demand is moderating ahead of Friday's official non-farm payrolls release. This labor cooling creates a complex policy backdrop for the Federal Reserve. While slowing private hiring supports expectations for monetary easing, Minneapolis Fed President Neil Kashkari reiterated that policymakers remain cautious, noting that gradual rate adjustments could still be required if underlying inflationary pressures prove persistent. In the fixed income market, long-term borrowing costs continue to press higher. The 30-year U.S. Treasury yield crossed 5% today, reaching its highest levels since 2007. Rising long-term yields increase discount rates across equity valuation models and tighten financial conditions for corporate borrowers. However, market indicators suggest this yield surge represents policy risk rather than runaway inflation expectations. 5-year TIPS break-even rates remain subdued, indicating that investors view multi-decade high nominal yields as a reflection of Fed policy stance rather than a permanent regime shift toward higher long-term inflation. Providing a stabilizing force for overall market liquidity, the U.S. Treasury Department released its third quarter refunding announcement today. The Treasury kept nominal coupon auction sizes unchanged at $125 billion and will rely heavily on short-dated Treasury bills for 61% of third-quarter net borrowing, avoiding sudden supply pressure on long-term bonds. Meanwhile, institutional deleveraging continues to echo through market positioning. Reports confirm that the Situational Awareness AI hedge fund, which saw assets surge from $9.3 billion to $45 billion earlier this year, suffered a severe leverage breakdown and sold its public equity portfolio to Citadel at a 10% discount on July 30th, explaining recent tech sector volatility. Heading into Thursday's trading session, key market watch points remain firmly established. Watch for resistance at the 7,800 call wall and support at the 7,700 put wall floor. As investors await Friday's non-farm payrolls report, maintaining strict risk discipline around options-driven volatility will be critical.